Thanks for coming out and watching the oxymoronic Reddit Professional Show, where I showcase the best and worst of the internet. Here I comment on brilliant and hilarious comment chains regarding dumb shit on the internet for you to enjoy. Make sure to subscribe, hit the little bell button so that you get notifications every time we come up with a new video. Enjoy this week's show.
ELI30, Personal Finance Tips for 30-something Adults, US. Topics here, while relevant to 30-somethings, are appropriate for anyone with a stable financial situation. Remember that marriage, homeownership, etc., are options, not requirements. Marriage changes your legal situation and, consequently, your financial options. Your married/single tax filing status is determined by your December 31st situation. Joint taxes may vary a bit versus single, but should be much better than filing married separately, except for certain income-based student loan repayment scenarios. With two incomes, withhold taxes as married at single rate to simplify your W-4. Ownership of assets/debts is complex and varies by state, but in the majority of cases, individuals retain assets and debts they had before marriage, e.g. student loans, whereas both parties share ownership of assets and debts acquired during the marriage. If a marriage ends, there is legal framework for separating assets/debts, which differs versus owning an asset or debt jointly outside of marriage. You'll have some additional options regarding health insurance and social security benefits. Marriage financial LPTs include: do not go into debt for a ring/wedding/honeymoon, decide how to use joint accounts, make big decisions together, including what constitutes a big decision. One of those big decisions could be buying a house. Here's some information on buying a house that applies to couples as well as single people. House buying usually involves thousands in transaction costs, so don't keep paying those if you move frequently. As a rule of thumb, buy only when you will stay in the same house for at least 5 years. Don't buy just because you don't like paying rent. While rent doesn't build equity, it also avoids maintenance and repair expenses, allows greater location flexibility, and doesn't require a down payment. Early mortgage payments are 75% plus interest, insurance and taxes, and only 25% equity. Property price appreciation is not guaranteed, but if you live somewhere for 20 plus years, ownership is almost certain to build wealth over time. Here's a calculator to do some what-ifs. While mortgage criteria vary by lender, you need stable income history, 2+ years, a good credit score, 700-ish. Low debt-to-income ratio, all monthly debt payments below 35% of gross income, and usually a significant down payment. One rule of thumb is your house should cost less than 3 times your annual income. Edit: okay, we'll let you have 4x, counting just the mortgage, if you are in a low property tax state. No Illinois or New Jersey. There are many types of mortgages. You usually want a fixed-rate mortgage to lock in current attractive rates in case you stay in your house for many years. A 30-year mortgage might have about a 4% rate. Each $100,000 of mortgage would cost $477 per month for principal and interest. With a 15-year mortgage, you get a lower rate but higher payments. At 3%, each $100,000 would be $691 per month. The 15-year saves you an enormous amount after 15 years when payments stop. Until then, it costs you more out of pocket, as you build equity. It's worth shopping around to get the best rate on a long loan. Principal and interest isn't the only cost. You'll also pay property taxes and insurance, which can add 20% to these payments, varying by location, and could be higher. All condos, most townhouses, and some standalone houses also have monthly homeowner association, HOA, fees for maintenance/repairs, that can be several hundred/month. Even with a fixed-rate mortgage, you'll find that taxes, insurance, and HOA fees often increase year over year. The gold standard in down payments is 20% of the house price, though many people put down a smaller amount. Some types of mortgages like VA and FHA allow lower down payments, but limited to certain borrowers, or with extra costs. For a conventional mortgage, you will usually pay private mortgage insurance, PMI, if you have less than a 20% down payment. On a typical size mortgage, this could be $100 to $200 per month. We recommend you save for your down payment, but gifts from family members are also acceptable to lenders. Adding all that up, that $200,000 mortgage on a $220,000 condo isn't just $950 per month for the loan, but also $200 for taxes, $250 for HOA or insurance, and $100 for PMI, so $1,500 per month all told. Buying a house often gives you enough deductible interest and property taxes to allow itemizing deductions, but only the amount of deductions that exceeds the standard deduction is your net advantage. i.e., if a couple can itemize $20,000 in deductible interest and taxes, including income tax, they benefit by a net $7,400 deduction and save perhaps $1,500 to $2,000 in taxes annually. Children are another popular 30-something decision. Here are some ways children affect your finances. Children are expensive. Even if they don't eat a lot, they add costs for housing, health insurance, and especially child care, potentially $10,000 to $15,000 annually for the first child, less per child beyond that. Many working couples find child care costs their biggest expense after housing. Family health care premiums can approach $1,000 per month in some cases. As a parent, married or not, you must budget for child support-related costs at least until children reach age 18. On the plus side, children can reduce taxes. A family of 4 with 2 children gets $28,000 plus in untaxed income as standard deductions and personal exemptions in any event. More if they can itemize. Then you could qualify for the child tax credit and the child and dependent care credit, which can be worth thousands of dollars annually. We'll discuss longer-term issues like college in a future installment. You have some time and options here. But we must cover life insurance now. If you have children, or significant responsibilities to your spouse, etc., you need life insurance. Term life insurance pays in the event you die, but otherwise expires after the 10 to 20-year term. Other types of insurance don't expire, but are much more expensive over time, so are not the best choice for most people, even if an old college friend tries to sell you this. In round numbers, you may need $500,000 to $1 million death benefit. That much 20-year term life for a 30-year-old is around $50 30/month, but it varies, so shop around. You also need disability insurance. You are more likely to be disabled than to die early, with loss of income plus high medical bills. Speaking of mortality, when you have children, you also need to have a will, whether or not you think you have a lot of assets to distribute. In the absence of a will, a court will decide what happens to your children if you, e.g., get killed in a car accident, as roughly 100 people do every day. Even if you don't want a house, spouse, or kids, you may have other financial events to deal with. Let's close with 2 popular scenarios: job change and self-employment income. You are probably going to change jobs several times in your career. It's a good way to increase income, statistics tell us. When you do change, you might have other financial ripples, such as moving costs, so take that into account. What do you do with your 401k and your employer healthcare? You own your 401k, net of unvested employer contributions. When you leave a job, you have options. You can leave the money in the old employer's plan, but not contribute, roll it over any amount without tax or penalties into an IRA, either traditional or Roth as your 401k was, sometimes roll it into your new employer's 401k, but that depends on them, or you could in theory cash it out. Never cash it out. That defeats the purpose of retirement savings. The IRA rollover is the typical recommendation, although it can affect your ability to do backdoor Roth contributions. Switching employers often means changing healthcare plans. This can mean higher, or lower, premiums, and resetting your deductible for the year. You may have to bridge a short coverage gap. You can do this at low costs without paying penalties. Your HSA stays with you whether or not you have an HDHP at the new job. Self-employment deserves its own post, and we've neglected it till now. Let's cover the high-level points to partially rectify that. Self-employment, 1099. Income is when you are paid for work without being an employee, W-2. You could be a contractor, take cash side jobs, or otherwise get paid without withholdings. You owe income taxes as well as self-employment taxes in lieu of Social Security/Medicare employee taxes. These are annoyingly large at 15.3% without a standard deduction until you reach 118K total income, after which it drops to just Medicare at 2.9%. You can owe 40% on self-employment income when you also have a regular job in the 25% bracket. The good news is you can deduct related expenses from your taxable net self-employment income, whether or not you can itemize otherwise. This can include mileage to slash from the job, home office space, cost of computers, cell phones, etc., travel expenses, education expenses. It's a long list. Carefully track these to correctly fill out your Schedule C. The not-so-good news is you have to directly pay taxes yourself, using quarterly estimated taxes if your self-employment income is significant. You use your crystal ball, figure out what you will owe in taxes for the year, and then send in part of that money in April, June, September, and January. You can increase regular job withholding to avoid quarterly estimated taxes on small self-employment income. Self-employed people have more and better options for retirement accounts, oddly enough. You get more control and higher contribution limits, and you can even make your own 401k, but you have to do it yourself. Since you're your own employer, most self-employed people don't need any special legal business status. You can remain a sole proprietor and report your taxes as personal income. You establish a limited liability company for liability reasons, but it doesn't change your taxes. To do that, you'd establish a corporation, such as an S-corp, which gives you some alternatives that can reduce your tax liability. Okay, that's enough for today. I know you are all eager to hear about other types of investments, so we'll save that for the next installment. You often see people recommend buying a house because you can deduct the interest, but you rarely see mention of it in relation to the standard deduction. Great stuff. Don't forget that being able to itemize allows you to also tack on other deductions, such as property taxes, state income tax, and other items. For example, let's say you are single and get the $6,300 standard deduction and you have $5,000 in state income taxes. Since you can't itemize, you can't deduct the $5,000 on your federal return. That deduction is completely lost. However, let's say you instead own a home and you pay $10,000 in mortgage interest and property tax. In the example above, you would think the net benefit is $3,700, $10,000 to $6,300. However, now you can tack on the $5,000 in state income tax, which allows you to itemize a total of $15,000 for the year, which is really a net benefit of $8,700. You can also start adding on other itemized deductions, such as charitable contributions, investment expenses, etc. Yep, but even after $5,000 in state taxes and $4,000 in interest and property tax, we haven't reached the standard deduction for married filing jointly in years. The cost of daycare for our 1-year-old son is around $2,400 a month. It's outrageous. He is really happy there though, so I can't imagine moving him to someone cheaper. That's insanity. At $28,000 a year take home, it really feels like I'd just rather not work. Sure, you probably make more than $40,000 or whatever the break even is, but you could get a lot done being home with the kid during the day. Then again, I'm just dropping my kid off with my dad during the day, free, trusted, and great with kids. This resonates strongly with me. We pay $1,700 for our 2-year-old's daycare, which is at our workplace. It's wonderful, the teachers and staff exceptional, and she loves it every bit as much as we do. We recently learned we're expecting number 2, due early next year, so we may well be paying close to $40,000 per year in daycare if we stay at the same place. Currently investigating other places, but it's sort of a hollow effort, since we really don't want to change. Top that off, we're living in a 2-bedroom townhome, so we're dealing with the debate of having both kids in the same room for a few years, vs upgrading. Probably worthy of its own post, almost. A great series. The only thing that I don't think stands any longer is mortgage equals 3x salary. That is unrealistic in a lot of places. For instance, houses in my neighborhood run at 8x my salary even though I am by no means badly paid. Let's do some quick numbers. You make $100,000. You buy an $800,000 house and finance, what? $700,000? Your principal and interest alone is $3,300-ish, then add in taxes and you'd be well north of $4,000 per month. On $8,300 gross. You won't qualify for that loan. $3,300 is pretty much what rent runs in most of San Francisco. Most couples both work after kids, etc. I'm not saying it's right, but the reality is, if I wanted to abide by the 3x salary, based just off mine, and still keep my job, I'd be looking at a 2+ hour commute each way. Rules of thumb are not enforced. I'm just pointing out that you couldn't get a typical loan on something 8x your income. You'd need 2 incomes, and then it would be 4x your joint income or something. You'd be surprised. We bought a house for $300,000 making $180,000 and the mortgage agent was shocked. She told us we would qualify for a $1.5 million or more house if we wanted, which seemed crazy to us. This was in 2012, so it was hardly a housing bubble era lunacy. Tangential, but what do people typically aim for in retirement income? My 401k sends out updates, and on this trajectory, I'll have $900 a month through just the single 401k. Is there a general rule of thumb, or is it completely lifestyle dependent? I'm a 30-ish journalist, so my brutally low salary for the beginning of my career really slowed my savings down. Reasonable people differ here. It depends on your cost of living. For many people, it's completely practical to retire on $50,000 per year, but if you want to live in New York City, then not so much. Suppose you got the typical $2,000 per month Social Security. Then you'd want to get another, say, $30,000 annually, $2,500 per month, from a 401k. That would be a sustainable withdrawal rate from a circa $1 million 401k, maybe a bit less. Something I learned recently: if your company offers an employee stock purchase plan with a discount, opt in ASAP with as high of a percentage of your salary as you can afford. My company offered a quarterly ESPP where you buy at the lower of the two values for the start or end of the quarter. So if the stock price was lower at the beginning of the quarter, you buy in at that rate. On top of this, they offered 15% off of the going rate. So let's do some simple math. Let's say that 5% of my salary for the quarter is $1,000, and my company's stock was at $10 at the start of the quarter, and $12 at the end of the quarter. I would buy $1,000 worth of stock at 15% off $10 a share, so 117 shares. I could sell this back immediately at $12 per share, which would be $1,404. I immediately made $404 just by letting them hold on to 5% of my salary for the quarter. That's way better return than typical. On the flip side, let's say that the stock was $12 at the start of the quarter, and $10 at the end. I'd buy in at 15% off $10 per share, for a total of 117 shares. I can sell this immediately for $10 per share to have 1,170. A return of 15%. It was essentially risk-free.
If you enjoyed this week's effective way to waste time, hit that like button and subscribe for more content like this. If you are enjoying the series, leave me a comment below. A special shout out to the content creators. You frickin' rock.